CNBC-TV18's Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, as always, my colleagues Sonia and Surabhi. Guys, hi, morning.
Hi, good morning.
The world's still holding together. We're still alive, guys. That's enough reason to be happy, right?
You know, every morning you wake up and you're like, which is the next big bank which is going to give us some bad news? And then today there's something on Credit Suisse, yesterday something on some other bank. I mean, every day is a new day and there's so much news flow, right, to negotiate.
You know, I said on closing bell, I think 2 days back, I said it's a prediction that U.S. regional banks will not blow up the world.
You did say
right?
that.
I said those issues will be behind us in a week's time.
I thought that you were saying that in a good way, that, you know, they'd be behind us.
But I don't think that U.S. will pass on the baton of worries to Europe, right? Which is the new epicenter in a way. So let's just quickly run you through what really happened. You know, I'm calling this is a headline trading market, right? So markets are on headline watch. I think that's perhaps the best way to put it. So US banks, as I said, have passed on all the worries to European banks now. Latest worries, of course, unless you've been living under a rock, is centers around Credit Suisse, which is the Swiss banking giant, and of course the collateral damage it can do. Unlike US regional banks, Credit Suisse, according to me, is a much bigger worry because of its vast global linkages. I mean, its collateral exposure, operations around the world, etc., which was not the case with US regional banks and small banks. And reflecting all of these fears, and by the way, issues around Credit Suisse are not new. They've been there, well-known, well-advertised. These are not the same issues which Silicon Valley Bank or others were facing. These were, a hedge fund blowing up, leaving Credit Suisse with losses. Actually, two of them blowing up, leaving Credit Suisse with losses. Lots of deposit outflows in the last quarter of 2022, etc. But it's at the center because of the fragility of the bank itself. Now, European banks index, the big European bank index, was down 8.5%. It kind of, in a role reversal, the fear came from Europe into US. US was trading okay, but by close, US bank index also was down about 3.5%. Mind you, even with these losses, banks were not the biggest pocket of losses in US. It was the energy sector, which I'll come to in just a bit. There was a Bloomberg story overnight, which I think provided a bit of a lift, right? Bit of a risk reprieve. I'll come to market changes in a bit, which basically said that Switzerland, the government has held talks on options to stabilize Credit Suisse. And this morning, we got a headline that CS, Credit Suisse, will borrow about $54 billion from the Swiss National Bank. This is just this morning, and I think that is causing a bit of a reprieve. Of course, in an environment like this, where everyone is doubtful of everything else, this will be seen as a temporary patch on a much bigger problem. But we're kind of commenting on all of this in real time. Now, how did the markets react? S&P and NASDAQ both were about 1.5% off the lows. The actual losses by close day on day were not much. I mean, actually, the NASDAQ was up a little bit. The 10-year completely flipped around from day before yesterday. It lost 23 basis points. It was up 25. It's lost 25. So absolutely extreme and wild moves. The dollar index ripped higher. The DXY was up 1%. It's at about 104.64. And oil prices saw a big crash. They lost about 5% yesterday, day before yesterday, that is, and they're down another 4%, 74 to a dollar. This is worries about the oncoming slowdown. Now, the setup is very, very simple. Just follow the screen. Don't try to be brave. Markets are in a pretty fragile place. And history teaches us that whenever there are weaknesses which emerge in the financial ecosystem, it takes time to heal. It takes time for the worries to recede. So, and of course, on top of it, with headlines coming at us thick and fast, it will be pretty volatile. Let the market give you a conclusive signal of a move. Now, levels, instead of saying, well, buy at this level, etc., let's look at upside levels. Nifty, and these are the same levels which we put out yesterday as well. We need for the market to trade above the 17,220 level for any sustainable bounce. And on the bank Nifty, we need to claw above the 39,740 level for any bounce. After yesterday's cuts, the distance between the current market price and these levels is even more. But, you have to have that for some confidence to come back into the system. Otherwise, I mean, stay away, wait and watch, and see how this pans out. Let the screen tell you what it wants to do. Sonia.
Oh, absolutely. I mean, the only thing to do right now is to wait and watch, right? And perhaps be a bit cautious because, as they say, nothing and no one is too big to fail. I mean, if you had looked at what happened with Credit Suisse overnight, it was a 30% fall in the Swiss stock exchange. I mean, and that's the second largest Swiss bank that we're talking about. So this contagion fear from the bank turmoil is something that's gripped global markets. And it's not done just yet, right? I mean, Credit Suisse, of course, will be borrowing about $54 billion from the Swiss National Bank. But apart from that, its biggest backer, Saudi National Bank, said it won't provide further financial aid. In fact, the stock, of course, the bank has had problems for very long through the course of the last 6 to 8 months. But the stock for the second day in a row hit an all-time low and plunged 30%. So that will definitely have ramifications across global markets. Europe was under a lot of pressure. Asian markets this morning are also indicating, a red start. At least most of the markets I saw, like Hong Kong, although the SGX is seeing a bit of a relief. But it's had a blow across most markets. First, that's the Hong Kong market for you, 300 points gone. For our own markets, the sell-on rally trade is something that continues to play out. Yesterday, we closed below 17,000. And now, in the last 1 month alone, the Nifty has lost over 1,000 points in one single month. So that's the ferocity with which this fall has come through. FIs as well, once again, selling continues. 5 consecutive days now. And FIs have sold over 7,000 crores. So the bulls are definitely on the back foot. How much more is the selling pressure going to come through? That we'll get to know. For now, even if there is a pullback, it could be a shallow one. And there is this banking turmoil is having a snowball effect into other asset classes as well. Just look at what happened with crude overnight. There was a big slide. In fact, Brent is now at the lowest level since December of 2021. That's the NCDEX, but the Brent crude prices are now below $74 a barrel, I think, 73.96. So all across, there is caution. There is a damage. It's called what? Collateral damage, right? Across asset classes. So let's see. I guess it's just better to have a little bit of patience is a good virtue. So it's just a little bit of more patience and wait and watch.
Oh, absolutely. I've just been thinking, what are the odds? How do you have a career and live through not one but 2 crises? I mean, right now this is a mini crisis, nothing compared to what we've seen in 2007 and 8. But that's going to be something, if in our careers we end up seeing like 2 full-blown global banking/financial crises,
and
not looking forward to it. And a pandemic in the middle. That's just a lot to, digest in a 20, 30-year career. But anyway, just to get back to the screens right now. So Asian markets, as Sonia was also pointing out, it's still largely red. It's very, very iffy. The dollar has cooled off a tad bit. It's at 104, but then it went to 105 overnight. So it's just, little change here and there. Some interesting sort of aspects. I think the biggest question now on everyone's mind, everyone who's in any market, is what will the Fed do next? So let's look at what, the Fed Watch tool is saying. Now, that's the present target rate. We know they're at 4.5 to 4.75. There is around, it's almost even, Stephen, between 0 hike and 25 basis points rate hike. In fact, the last time I checked the probability, we were talking 51.3% saying no change, not even a 25 basis points, and around 48% saying 25 basis points. And it's whichever way you cut it, this is not going to be easy or pretty for the Fed. The last thing you'd want to be is the US Federal Reserve Chairman right now, because if you cut, then the market will take it as a symbol of more pain, more problems ahead. If you don't cut, and or rather, if you go ahead and hike, then the market will probably throw a tantrum saying, okay, the Fed is not taking cognizance of the pain in the markets around the world. So that's the Fed for you. Just a point, levels have come and gone, so nothing is sacrosanct in our market. That was Dr. Doom, Nouriel Roubini. He has been consistently speaking and tweeting and talking since yesterday, saying that Credit Suisse is a Lehman moment. We're talking $700 billion in assets connected across the global financial system. And the extent of those interlinkages is not even clear right now. In fact, he's going on to say that right now this is not a credit problem. This is an asset liability mismatch across banks because of the way interest rates have moved. But he's arguing that eventually you get to that recession and then you start getting credit quality problems as well. So he's really going all out in terms of predicting a doom scenario. But just to come back to the data and the relevant factors here at home, we are a whisker away from the September lows. The last low that we got was 16,747. Just wanted to put the number out there for specifics. The FPI data that Sonia alluded to, they've started selling, and the net positive number for March is going down. So far in March, we are still positive, but that's to the tune of around 12,500 odd. And this is largely because of block deals. We don't have X of block deal data very clearly. So therefore, this number is looking not as bad. There were sellers in January, in February. They became buyers only in March. So let's see how that plays out. Last but not the least, I was hearing yesterday from a couple of people that I was speaking to, Prashant, that if you take out the SIP numbers, even mutual fund inflows haven't been rosy. In fact, we're net negative, right? Minus the SIP number. So where does the support really come in from?
That number has been negative for a few months. And you said Lehman. Guess what the name of the chairman of the board of Credit Suisse is?
Lehman. Axel Lehman. I mean, that is just
make this
Let's not say that word too many times, guys. And don't manifest
I just saw. I said, really, I had to go and. Anyway, two ends at the end, not one. But anyway, the resemblance is freaky. Well, before we move on, let me quickly tell you what is lined up in the first half hour of the show. We get you updates from markets across the globe. Jahangir Aziz is a conversation you don't want to miss. That's coming right up. Our research team will bring you our top 10 list of stocks to watch. At around 8:30, Anand Tandon will join in for a quick market conversation.
Okay, by the way, before anything, gold prices, we forgot to mention that they're zooming. Generally, when there's risk aversion towards equities, gold rises. Gold is now at over 57,000 rupees. And in the global markets, gold has gone up to above $1,900 per ton. So, just keep an eye out on that. 1911 now on the precious metal. Well, on the equities front, we have Eric Fishwick of CLSA who says that if global markets require rates to be cut to regain confidence, it puts both US and the European Union in a bind. Without cuts, he says risk aversion rises, financial conditions tighten, and the crisis tail gets fatter. With cuts, he adds, looser financial conditions minimize the economic impact of market turmoil, making lower rates inappropriate from an inflation perspective. He says that he does not have a solution for the paradox, but separation of liquidity, balance sheet, quantitative easing or tightening decisions from inflation and the rates policy would be a good starting point.
Okay, let's get you some money market views as well. And this is the view coming in from Parul Mittal Sinha of Standard Chartered, who says the USD INR saw upward pressure on a spike in global risk aversion. A slip in yields and equity sell-off, even as a drop in oil prices, helped limit that upside. She expects the USD INR to trade in a range of 82.25 to 83.25 next week, with volatility possibly checked by USD sales. She says ECB FOMC policy decisions are on watch, with dollar and oil price moves likely to stay key forex drivers.
All right, and on the bonds, Parul says domestic yields slipped last week, tracking a sharp down move in global yields with pricing of central bank rate hikes correcting lower amidst high market volatility. She expects the 10-year yield to trade in a range of 7.3 to 7.40% next week, with global yields as the key driver. She says all eyes are on the ECB and the FOMC policy decisions due today and on March 22nd, respectively, for further market direction.
Okay, so there's a lot of macro news points to watch, but we do have a lot of stock-specific action as well. So let's quickly run you through the list that we'll cover in our top 10 segment. We're looking at ONGC, Oil India, Interglobe Aviation, Asian Paints, Godavari Power and Ispat, Sarda Energy, and Orient Paper on the upside. Positive news flow surrounding them. Samvardhana, Motherson, Hero MotoCorp, and Patanjali Foods are stocks that are likely to open in the red. We'll tell you why in just a bit.
All right. Well, we spoke with the former governor of the RBI, Raghuram Rajan, on the current issues.